Hello, money and banking students. We are now in week 3, and in week 3 you're going to have chapter 6, 7, and 10. Chapter 6 is kind of a continuation discussion of interest rates and bonds. In any market, you're going to have supply and demand for, say, apples. What's going to be the same thing for supply and demand for bonds. And there's various factors that can influence shifts in demand or supply for bonds, and you'll go through the readings, kind of determine what some of these factors would be. But again, remembering that bonds have an inverse relationship to price. So if the price gets more expensive, the rate of return you're going to get in terms of an interest rate is going to decline. But there's a variety of factors. For example, if people get skittish about the stock market, oftentimes they'll jump into the bond market. Or if a company is not doing so well, and if their bonds go to what we call junk status, that's anything that's not investment grade by Moody's and Standard & Poor's. They have four top tiers for the highest graded bonds, and anything below that is considered junk because it's considered a higher risk of default. But of course, if you buy one, you may be able to buy it for $500 on the 1,000, and as long as they make the interest payments and make a payment on the bond, you can make a really nice return on it. Again, the huge risk is what if they don't? But if you ever see mutual funds that have called high yield funds, they're basically portfolio managers are investing in a lot of junk debt in the hopes that most of them will pay off. Granted, they'll lose on a few of them, but the rate of return they will get from the ones that do pay off will offset their losses. So chapter 7, we look at that chapter and we start to get into the term structure of interest rates. Why is the yield curve shaped the way it is? When I used to be in treasury management in the corporate world, I used to use the treasury yield curve as kind of a benchmark compared to our borrowing cost. So I'd be curious to know if interest rates went down or up, how much did that influence my borrowing cost? Did it go up and down the same? And if it didn't change as much, maybe the market perceived us differently. But from the risk-free rate perspective, it's the idea, think about treasury bills, notes, and bonds. The government issues a lot of debt to cover their expenses. It's a highly liquid market. It's a highly valued market. Right now, interest rates on treasuries are still relatively historically low, but we're starting to see some of those long-term interest rates on treasuries start to go up. And this will probably continue to happen, especially if the Federal Reserve raises interest rates in September. So this chapter looks at the different theories related to why the yield curve is shaped the way it is. They called, in terms of what we have there listed in the textbook, could be in the terms of a segment in markets, could be expectations, preferred habitat. I like to think of these different theories in this way, that, segment in markets, there are certain people that want long-term debt, there's certain people that want short-term debt, there's certain people that want to lend long-term, there's certain people that want to lend short-term. So it's, supply and demand shifts that would determine the interest rates. The other one is going to be based on kind of expectations of the future, that if a 1-year rate is paying 1% and a 2-year rate is paying 3%, then you could predict what the 1-year rate would be 1 year from now. The final would be based on just simply liquidity theory. The longer that you hold on to your money locked up, the higher rate of return. You want like a maturity premium. Just if you were to buy a 1-year CD versus a 5-year CD, you would expect to get a higher rate of return on the 5-year CD. So last thing in your readings, it deals with efficient market hypothesis. I put for the forum discussion out there this week. It's going to focus on that. I'd like you to watch a video called Mind Over Money. Maybe perhaps some of you have seen it before if you've been in one of my finance classes, but it begs the question whether markets are efficient, that at any given time an asset, a stock, a bond is accurately reflecting that price in the market given all available information. And it kind of goes into the question of whether people are rational or irrational when it comes to their decisions of money, and if markets are rational, are they efficient? You're going to hear a lot of opinions from different economists. Even Robert Shiller the other day, they were asking him, what do you think is going to be the next big meltdown? Is it the Greek crisis? Is it the student loan bubble? And a lot of the economists, I think I mentioned previous weeks, it's going to be old people in the United States that how are we going to continue to have these expenditures with fewer and fewer people contributing to the system. So it'd be a different type of shock. But anyway, China is having some trouble with their stock market, and the Chinese government is trying to jump in and provide some liquidity to keep the market up. But it kind of begs the question, are the Chinese misinformed? Are investors misinformed? And the markets maybe are not efficient. So I want you to post your opinion about whether you think the Chinese market is efficient after seeing the video and reading the articles. And there's no right or wrong answer on this. As you'll see in the video with Mind Over Money, economists disagree widely on their viewpoints about efficient market hypothesis. But essentially there's three forms of efficient market hypothesis. Weak form, that you can't use the past to try to predict the future. Just because this stock has acted this way historically in the past, it's going to continue to do that. What I call, that's kind of weak form. Semi-strong form would be based on any information in the market that's released as soon as like some results come out for the quarter, for how the company did revenue-wise and earnings, that stock price should adjust immediately. And then the strong form would be even insiders, such as CEOs, CFOs, when they buy or sell stocks, because they have to report the SEC, you don't have enough time to go in there and try to outperform the market. So I like to use the analogy of going to the grocery store. I remember I was in Walmart the other day and trying to decide, usually they have like 2 express lanes open. There's 40 people waiting there. I think yesterday on July 4th, it was like maybe 4 lanes. And I was joking with the guy next to me, like which one we should choose. Because pretty much, sure enough, whichever lane you choose, you end up being in the longest line. So unless you were to know something better than everybody else, but since everybody's competing about information and looking at everything the same and trying to figure out which line is the longest, it's kind of the idea that when it comes to investing, everybody's doing the same thing too. So a lot of people argue, don't sweat it, just pick the S&P 500 index fund for your investments, because most professional money managers have a hard time beating the average for the S&P 500 over the long time. And if you subscribe to that theory, then it says that markets are efficient. So, well, that's it for this week. Make sure to wrap up anything that you had for week 2, and then get into that form discussion for week 3. And then in week 4, just a little brief note now, going to be a little bit lighter that week, but you will have an exam that week, and we'll talk more about that the following week. So take care and have a great week.